Hi everyone, it's Maili here. And I wanted to start by saying what a month it's been. If you've been following the headlines, you know exactly what I mean. Because investors have been tested in a very real way. But here's the thing. If you've been a client of ours for a while, then this story should feel familiar. And that familiarity is really important. Because you know what to do. So let's get into it. On February 28th, the US and Israel launched military strikes on Iran, making the start of what's now being called the 2026 Iran War. Almost immediately, global markets went into risk-off mode again. And for good reason. The Strait of Hormuz, which carries roughly a quarter of the world's maritime oil trade, was effectively closed. And this caused our market sell-off. From their January highs, the S&P 500 fell nearly about 10%. Through late March, and this is the steepest decline that we've seen since the April tariff tantrums a year ago. Oil prices, which were around $67 a barrel before the war, surged to nearly $113 a barrel in early April. Inflation fears spiked again. Consumer sentiment dropped, and we started hearing something we've heard before. This time, it's different. We hear that a lot, and every time, we take a breath and get back to the data. Here's what we know about markets. They are forward-looking mechanisms. They don't wait for the dust to settle. They price in fear, uncertainty, and bad news, sometimes very aggressively. And then they recalibrate, sometimes before clarity emerges. We've seen this time after time. We saw this after COVID. We saw this in 2022 after interest rates went up. We saw this even last year in April when the tariffs were announced. And each time everyone said, this time it's different. Each time the causes are different, but for those who stay the course, they can be rewarded. And what happened last month is fairly textbook. Bad news on the weekends, followed by a market rally on Monday and Tuesday. A ceasefire announced over social media sent the Dow over 1,300 points higher the next day. And then talks broke down over the weekend about a ceasefire, and then overall markets rallied again. We are living in a world where market volatility is the norm. And this can be expected for 2026. Even a single tweet about how Iran wants to make a deal can cause the markets to go higher. So we know that volatility is a feature and not a bug. As of April 15th, the S&P 500 actually recovered to hit an all-time new high, recovering all the losses from earlier this year. And the NASDAQ closed at a record level as well, up from the March lows. The S&P 500 rose 10 out of 11 consecutive trading sessions, gaining over 10% across that stretch. And in fact, this may have been a faster rebound than even what we saw during the COVID market crash in 2020. Oil prices have also eased back meaningfully. And the market's fear gauge, measured by the VIX, dropped back to more normalized levels, signaling that the immediate panic may have subsided. And why is this all important? It's because despite a war, an oil shock, inflation fears, and relentless uncertainty, cashing out is not the answer. The major equity indexes are actually back to positive year to date, recovering from the earlier losses and back towards new highs. So what did we do and what did others do? Well, during the height of the fear, when oil prices were above $110, when the headlines were scary and the Strait of Hormuz was effectively closed, we stayed invested for our clients. We remained focused. We didn't panic sell. We didn't move entirely to cash. We did not abandon our long-term plan to look good in the short term just to provide what looked like comfort. A lot of investors did. And right now, many of them are scratching their heads, sort of wondering, when do I get back in? And what to do? And here's the painful truth about sitting on the sidelines. Missing the best days in the market can feel just as bad, if not worse, as riding through the worst days. The biggest up days are almost right in the middle of all the fear, right when you least expect it. Here's an interesting chart that shows intra-year market declines over the past few decades. And what's really neat to see is that even though markets fell 10, 15, sometimes 20% lower in the year, they often recovered to positive returns for that year. So you see, the danger isn't in the decline. The danger is in selling and then missing the recovery. You know, amidst all this noise, there's been a remarkably strong earnings season underway. You know, companies are still reporting fairly steady profits, and I think this is being underappreciated. For example, in the financial sector, JP Morgan reported net income of over $16.5 billion in the first quarter, up 13% year over year, as did Taiwan Semiconductor, which beat earnings as well. Johnson & Johnson grew quarterly earnings nearly 10% and raised its guidance. So when companies are showing about 14% year-over-year growth in profits, that's the structural foundation below the market volatility. Even when geopolitics can rattle the markets, the good news is underlying business growth is still there. And so that's why the markets are repricing back in a positive way. In my book, Smart Risk, I talk about how the goal is not to avoid risk entirely. It's to take the right risks intentionally with your eyes open. And this past month was a good example of that philosophy in action. We've stayed diversified across geographic sectors, different industries, and across asset classes, meaning that when energy shocks take place, they can act as a natural hedge for these other types of volatility in perhaps the technology sector. Diversification doesn't mean you avoid all pain. It just means that you're not going to be hurt by one single thing. So we've remained invested through the volatility and looking forward to recoveries that tend to be sharp, fast, and sometimes unforgiving to those who cash out too early. And we remain focused on the long term because that's how true wealth is built and compounding over time. Here's another interesting chart that I think you'd like to see that shows the equity markets, in particular the S&P 500, throughout major crises, especially geopolitical crises over time. This shows that despite wars, crashes, pandemics, recessions, every single time the line ends up going back up again eventually. And the direction is from the lower left to the upper right. And that's not just optimism, that's history. Markets have recovered sharply from a real and serious geopolitical shock. And while the conflict may continue, we are seeing signs of de-escalation underway. And oil prices are also reflecting that. Corporate earnings are still strong. Central banks are still on hold. Investors who are staying the course are being rewarded once again. Now, we continue to expect volatility. We always do, and we are prepared for it. And our job is to be positioned to capture the long-term benefits while managing the risks that come along with it along the way. One more thing, I was recently interviewed by Bloomberg News Network, the business news network on television, for an interview live that I think you'll find really interesting. And so we've included a link, and I hope you watch. We're also going to be interviewed again live on BNN on April 30th at 10 a.m. Pacific Standard Time. And of course, I hope you can join us at our upcoming Wealth Matters client event that we're holding on May 5th at the Point Grey Golf Club, where I'm going to have two amazing speakers come in from California to share with us their ideas on how to invest in the world of AI, in a world of transition. And it's going to be a really interesting event, and I hope you can join us. Apollo Lupescu from Dimensional Fund Advisors is backed by popular demand. We also have a very special guest, Managing Director, Systematic Equities, Mr. Richard Matheson, coming in from BlackRock, one of the world's largest asset managers. And they have some incredible AI-based tools that I think you want to hear all about. So stay tuned for that. And again, thank you for trusting in our process and in our relationship. And I look forward to seeing you again soon. Have a great day.